Britain is facing double-digit inflation for the first time in 40 years, with mortgages, fuel and food prices set to soar as the Bank of England warned that Russia's invasion of Ukraine will hammer the economy this year. The Bank of England raised interest rates again today amid fears the rate of inflation will increase to around 8% in the coming months, or even hit double digits. Families are facing more mortgage pain after the Monetary Policy Committee lifted the base rate from 0.5% to 0.75% as it tries to deal with spiking price rises. The MPC voted by 8-1 in favour of the increase, to the highest level since COVID struck. One member wanted to keep rates on hold, in a turnaround from last month when a significant minority want to be more aggressive with rises. The bank admitted that inflation looks likely to sail past its prediction of a 7.25% peak, potentially by several percentage points, in the wake of the Ukraine war. However, while the bank's main remit is to control inflation, the global nature of the problems means the lever of interest rates might only have a marginal effect. UK plc is already expected to suffer a severe slowdown with anxiety that it could even slip into recession amid soaring prices, the dreaded stagflation scenario. The pound swung lower after the bank's announcement, losing some of its gains against the US dollar, which was weakened by its own interest rate hike yesterday. Bank of England Governor Andrew Bailey faced a difficult balancing act in the latest interest rate decision today. The Bank of England raised interest rates again today amid fears the rate of inflation will increase to around 8% in the coming months, or even hit double digits. Rates are at historically low levels but increased again today to 0.75%. Wages have been struggling to keep pace with soaring inflation over recent months. Just last month the bank had suggested that inflation was set to peak at just over 7%, but today it suggested the figure will be several percentage points higher. Are we heading back to 1973? Ministers have warned of a direct historical comparison between the current Ukraine crisis and the fallout from the Yom Kippur War in 1973. That saw oil prices nearly quadruple when Arab nations imposed an embargo in protest at the West's support for Israel. In the ensuing chaos, UK CPI inflation reached just under 23% in 1975, while by 1979 interest rates had spiraled to 17%. The bank had already hiked rates twice in the past 3 months, with the latest quarter-point rise in early February accompanied by warnings of more to come. But Russia's invasion of Ukraine has seen financial markets trim their expectations for rate rises this year, with central banks in the UK and worldwide predicted to tread more carefully. Meanwhile, ministers have been warned Britain is heading for a de facto lockdown caused by soaring fuel prices. Conservative former Minister Robert Halfon said parents will soon no longer be able to afford to take their children to school while workers will struggle to get to work. Transport Secretary Grant Shapps said he would have further discussions with Chancellor Rishi Sunak on the issue. Speaking at Transport Questions, Mr Halfon told the Commons, "In Ireland it's a very happy St Patrick's Day because they've cut fuel duty over the past week. I thank for what the government has done on the fuel duty freeze, but the fact is motorists are paying £1.60 plus for their petrol and their diesel. We're heading to a de facto lockdown where parents can't afford to take their kids to school, where workers can't afford to commute by car and have to stay at home." Economists have also estimated that Sunak will raise taxes by 2% of GDP in his spring statement next week. If Sunak's tax rates are implemented, it will raise the UK tax burden by around £46 billion, according to the Institute of Fiscal Studies. Meanwhile, most economists expected the Bank of England to set a 0.25% increase in interest rates, with the case for action having been reinforced after official data on Tuesday showed a roaring UK jobs market. But the MPC shied off voting for a larger rise as it faces the prospect of a stalling economy. The MPC said that UK GDP in January was stronger than it predicted last month but stressed that growth is likely to slow due to the fallout from Ukraine. The ONS said last month that consumer price inflation increased by 5.5% in January and the central bank previously said it could peak at 7.25%, but it has now warned it is likely to rise more sharply. In the latest report, the bank said, inflation is expected to increase further in coming months, to around 8% in Q2 2022, and perhaps even higher later this year. The projected overshoot of inflation relative to the 2% target to an increasing extent reflects global energy prices, with some further material contribution from tradable goods prices. There are fears growth may come under pressure in the second quarter and beyond as the cost of living crisis and conflict in Ukraine weigh on confidence. In a grim warning, the MPC added, global inflationary pressures will strengthen considerably further over coming months, while growth in economies that are net energy importers, including the United Kingdom, is likely to slow. Bank Governor Andrew Bailey has admitted there is little monetary policy can do to influence global commodity prices, but said on raising rates in February that cost pressures would be even worse if it did not take action. Shadow Treasury Chief Secretary Pat McFadden said, "This shows how serious growing inflation and the cost of living crisis is. The government has allowed the cost of living crisis to spiral out of control since September and now will make it even worse with an unfair tax hike. The Conservatives should halt their national insurance hike in April, and they must look again at Labour's proposal for a one-off windfall tax on oil and gas producers to cut household energy bills by up to £600. How inflation threatens families and the public finances. Inflation has long been seen as one of the biggest threats to economies. In extreme examples, it has spiraled out of control and sparked panic. The German Weimar Republic effectively collapsed after the value of the mark went from around 90 marks to the US dollar in 1921 to 7,400 marks to the dollar in 1921. In Zimbabwe between 2008 and 2009, the monthly inflation rate was estimated to have reached a mind-boggling 79.6 billion%. Although inflation has faded in the minds of Britons who have become used to ultra-low interest rates and stable prices, it caused chaos here in the 1970s. Deregulation of the mortgage market, the emergence of credit cards and an overheating economy drove the rate to an eye-watering 25% in 1975. People would rush to buy goods with their wages after payday, as the costs were rising so quickly. Strikes erupted as there was pressure for pay packets to keep pace with prices. Unemployment rose as the economy tipped into recession, and the government had to pump up interest rates in a bid to bolster the pound and control the surge. That meant mortgage interest payments spiked into double digits. And as a result, servicing the national debt became a serious problem. Ed Monk, Associate Director at Fidelity International, said, "Today's rise in interest rates underlines how seriously policymakers are taking inflation, even if they stopped short of the half-point rise some had predicted." The Monetary Policy Committee members will know that some of the most painful price rises being felt by households, such as those on energy, fuel, and food, will not be brought under control by raising borrowing costs, but the fact they are acting anyway suggests they are worried about price rises feeding through to higher wages and becoming more ingrained. With growth still positive, the case for further tightening remains intact, but the bank will be watching closely for signs that the cost of living squeeze is itself beginning to hurt demand. The bank's commentary around today's decisions suggests modest tightening as the year goes on, which might indicate it is willing to turn more dovish if growth slows. Ian Mackenzie, Chief Executive of the Guild of Property Professionals, said, "The country is in the midst of a cost of living crisis, with the price of household bills and essential goods rising across the board." The Bank of England has increased interest rates to pre-pandemic levels in a bid to get inflation under control. This will come as unwelcome news to millions of people on tracker mortgages or variable rates that will feel another squeeze on their finances. Those on fixed-rate mortgages are safe for now, but consumers should keep an eye on interest rates in case their deal is up for renewal soon. Our research indicates that about 1.5 million fixed-rate mortgages are expected to end this year and next. Susanna Streeter, Senior Investment and Markets Analyst at Hargreaves Lansdown, said, "With the shadow of stagflation looming, the Bank of England is in a difficult predicament, so it restricted the rate rise to 0.25 percentage points to try and ensure growth isn't choked off while it tries to get a grip on rampant prices. But this limited move means inflation will slip away and slide upwards again." The commodity chaos unleashed by the conflict in Ukraine is set to feed through to consumer prices, and unwelcome energy bills are already poised to land on mats in April. The